So if you've got a mortgage, chances are you're paying for some kind of mortgage insurance. But if you ever stop to ask who that insurance is actually for, honestly, it's one of the biggest points of confusion for homeowners, and getting the answer wrong, well, that can be a massive mistake. Today, we're going to make it all crystal clear. All right, let's kick things off with the big question. You hear these two terms all the time, mortgage protection and mortgage insurance. And yeah, they sound pretty much the same, but I'm telling you, they are worlds apart. One of them is designed from the ground up to protect your family, and the other one, yeah, it's not protecting you at all. Knowing the difference is a genuine financial superpower. And that leads us right to the most critical distinction of all. Who is actually getting the protection here? To figure this out, we've got to break down the two main types of coverage you'll see: mortgage protection insurance, or MPI, and private mortgage insurance. You guessed it, PMI.
Okay, so on one side, you've got mortgage protection insurance. That's MPI. Think of this as your family's personal bodyguard for the house. Its job is to make sure your family gets to stay in the house no matter what. On the other side, you have private mortgage insurance, PMI. This one protects the lender, the bank. It's their safety net if you can't make your payments. You pay for both, but only one of them truly has your back.
I mean, when you see it laid out like this, the difference is just night and day, right? With mortgage protection, the check goes to your family. They get the money, they get the control. With mortgage insurance, that payout goes straight to the bank. And here's the real kicker. You are often forced to pay for the bank's protection. That's the PMI, especially if you have a smaller down payment. But the protection for your own family, that's totally optional. That's a choice you have to make for yourself. So, for the rest of this explainer, we're going to forget all about the one that protects the bank. Let's focus on the one that really matters, the one that acts as a financial shield for your family. Mortgage protection insurance. You know, when most people think about mortgage protection, their mind immediately goes to what would happen if someone passed away. And that's important for sure. But the reality is, there's a much, much more common threat to your home that you might not even be thinking about.
This might come as a shock, but the data doesn't lie. A major medical crisis, getting seriously sick or hurt, is one of the top reasons people lose their homes. In many cases, it's an even bigger factor than death. So, this isn't just about planning for the end of life. It's about protecting your home from the curveballs life can throw at you while you're still living it.
So why is getting sick such a huge financial risk? Well, it's really a triple threat. First, you get slammed with crushing medical bills. At the same time, you probably can't work, so your income just stops. And to top it all off, most families simply don't have a big pile of cash sitting around to cover the mortgage for months on end. It is the absolute perfect storm for financial disaster. So, if the single biggest threat to you keeping your home is getting sick while you're alive, how on earth do you protect against that? Well, this is where modern insurance came up with a truly game-changing idea: creating insurance for the living. You know, insurance didn't always work this way. Way back when, it was simple. It was all about the death benefit. But then, in 1983, a cardiac surgeon named Dr. Marius Bernard had this profound realization. He saw his patients were surviving these major surgeries, which was amazing, but they were being financially wiped out in the process. So he invented critical illness insurance, and that incredible idea evolved into what we now call living benefits, which are a standard feature in so many modern policies. The official technical term for this feature is an accelerated death benefit, or ADB. And it's actually a really brilliant, simple idea. It just means the policy lets you get in advance to accelerate a piece of your death benefit right now, while you're alive, at the exact moment you need that money the most. Okay, so being able to access money while you're living sounds fantastic, but how does it actually work in the real world? This is where we need to get really clear and set some expectations about what a payout actually looks like.
And that leads to the number one question I get asked about this. People say, okay, so if I have a $500,000 policy and I have a heart attack, do I get the full $500,000?
And the straight answer is no. In almost every single case, when you use a living benefit, you get a portion of your total death benefit, not the whole thing. And trust me, there is a very, very good reason for this. The best way to picture it is like this. Your total policy is a full glass of water. A living benefit is like a straw. If you get sick, that straw lets you take a vital sip from the glass right now to put out the immediate financial fire. You get to use some of that water when you are absolutely desperate for it. But the goal isn't to drain the entire glass. So how big of a sip are we talking about here? Well, it really depends on the severity of the situation. For a terminal illness, you might be able to access a huge chunk, maybe up to 95%. For a critical illness, like a major heart attack or stroke, it could be anywhere from 25 to 80%. And for a chronic illness where you need long-term care, it's often paid out in monthly checks. So the whole point is this. The goal is to give you a life-changing chunk of cash right now to stop a financial disaster in its tracks, while still making sure there's a significant benefit left over for your family later on. It really is the best of both worlds.
Now, all of this brings me to a really important question, especially for anyone who thinks they already have coverage. Are you positive your protection is up to date? Because believe me, there is a massive generational gap when it comes to this stuff. Here's the deal. Insurance has changed a lot. If your policy is 15 or 20 years old, there is a very, very high chance it's missing these powerful living benefits. It might just be an old-school policy designed to pay out when you die, leaving you completely exposed to the financial risk of getting sick.
Modern policies? They're built for real life. They offer a lump sum of tax-free cash if you have a critical illness, like cancer or a heart attack. They can have riders that literally make your mortgage payments for you if you get disabled and can't work. And they can provide money to help with long-term care. It's a complete safety net, designed for the challenges of life, not just the end of it.
So, I'll just leave you with this one final thought. You wouldn't dream of owning a home without insurance to protect it from a fire or a break-in, right? But the far more likely risk is that life itself, an unexpected illness, a sudden injury, is what will threaten your home. So the question you really have to ask yourself is this: is your home truly protected from life?